Warren doesn't have a lot of faith in economists, nor do we. But the bigger reason, frankly, is that contrary to what most investors think, there isn't as much of a direct link between the trajectory of the economy and that of the stock market. In other words, even if someone could accurately predict the economy, a very big if, it wouldn't reliably tell you what will happen to the stock market or how to invest. Before we show you why Buffett basically ignores the economy and some of the numbers around that why, let's look first at what it looks like when you can identify a reliable indicator or predictor for future returns. Bonds, for example, have a very good predictor of future returns. It's the yield to maturity at the time of purchase. This graph shows the yield of the 10-year US Treasury bond at various points in time on the x-axis, and the return of that bond over the following 7-year period on the y-axis. Even though the maturity doesn't match the return period, it's a long enough time where the yield and the subsequent return are clearly linked. As the beginning yield increases, so does the long-term return. You'll notice something in the graph called an R-squared, and that describes how much of one variable in the analysis explains movement in the other variable. The higher the score, the more connected the two are. In this case, it's saying that about 0.9 or 90% of the variability in the bond return is being explained by that starting yield. That qualifies as a highly reliable indicator and is worth paying attention to. Unfortunately, nothing that reliable exists for stocks. Intuitively though, one would think the economy and its rate of growth would be one such indicator. Surprisingly, and for a lot of reasons, it is not. We can see that in this chart that looks at economic growth and equity returns of the G7 countries plus China, going back to 1960. The x-axis is the 5-year real GDP growth, and the y-axis is the 5-year annualized returns for the stock market. Unlike the prior graph we looked at, the dots here look entirely random, and that R-squared is basically 0. In other words, an investor looking for some indication or formula that might translate an economic growth projection into a market prediction isn't going to find it. This doesn't mean we don't follow or have our own opinions about what is happening in the economy. But like Buffett, when it comes to making investment decisions, we don't find those opinions or projections all that helpful. In fact, we'd go as far as to say they are typically unhelpful. People end up delaying investing or attempting to time the market, and we know that typically does more harm than good. We want to focus our time and attention only on things that matter or are more reliable. I'm sure there are still plenty of skeptics out there though. Perhaps our lens was too broad or our time frame too long. So stick with me for our next video as we narrow that lens and look specifically at the US equity market.